Are you giving money to charity every year, but wondering if there is a smarter way to do it? Maybe you're writing checks throughout the year. Maybe you're donating cash because it feels simple. Maybe you had a really strong income year and now you're asking a bigger question. If I already want to support charitable causes, is there a way to do that that is also more tax efficient? That is exactly where donor-advised funds can come into the conversation. I'm Josh Duncan, partner at F5 Financial Planning, where we take a fiduciary approach to maximizing our clients' wealth. In this video, I'm going to explain what a donor-advised fund is, how it can create tax efficiency, when it makes sense to use one, what the costs look like, and when it may actually be the wrong fit. Because donor-advised funds can be extremely helpful, but they are not automatically a good idea just because they sound sophisticated. This is one of those planning tools that works really well in the right situation and can be unnecessary in the wrong one. So my goal today is to help you understand not just what a donor-advised fund is, but how to think about it like a planner. When does it actually improve your life, your giving, and your taxes? And when does it just add another layer of complexity you do not really need? Let's start with the basics. A donor-advised fund, or DAF, is basically a charitable account. You contribute money or assets into that account, you receive a charitable deduction in the year of the contribution if you itemize, and then you can recommend grants from the account to qualified charities over time. That timing difference is the real appeal. You can make the charitable contribution now, but take more time deciding where the grant should go and when those grants should be made. That can be very useful because your tax planning and your charitable planning do not always happen on the same timeline. Maybe this is the year when your income is unusually high. Maybe this is the year when you want the deduction. Maybe you do not want to rush into making a bunch of year-end charitable decisions in the last week of December. A donor-advised fund gives you some breathing room. Now, one very important point here is that once assets go into the donor-advised fund, they are no longer your money. They are charitable assets. The contribution is irrevocable. You can recommend grants and typically choose among investment options inside the account, but legally the assets belong to the sponsoring charity that administers the DAF. That means this is not a temporary holding place for money you may want back later. This is not a savings account. This is not an emergency fund. This is not an investment account for future personal use. This is charitable money. And that distinction matters a lot because if you are going to use a donor-advised fund well, you need to go into it with the right mindset. This is for people who are already charitably inclined. It is not for people who are only interested in chasing a tax deduction and are not really sure they want to give the money away. Another advantage is organization. For families who give regularly, a donor-advised fund can create one central place to manage charitable gifts. Instead of multiple receipts, scattered records, and a year-end scramble to remember what you gave and where you gave it, a DAF can bring structure to the process. So at a high level, I think of a donor-advised fund as a planning tool that helps separate three things that people often mix together: the tax deduction, the funding decision, and the ultimate grant decision. That separation is what creates flexibility. And that brings us to the next question. How does this actually create tax efficiency? The easiest way to understand the value of a donor-advised fund is to think about three tax levers. The first lever is timing, the second lever is asset selection, and the third lever is bunching. Let's walk through each one. First, timing. When you contribute to a donor-advised fund, that is when the charitable deduction is created, assuming you itemize and otherwise qualify. The grants you recommend later do not create a second deduction. That means a donor-advised fund can be very useful when you want the deduction now, but you want more time to decide which charity should receive the money and on what schedule. This is one reason donor-advised funds are often attractive in unusually high-income years. Maybe you sold the business, maybe you received a very large bonus, maybe you exercised stock options, maybe you sold real estate or had a large capital gain. Maybe you completed a Roth conversion. In years like that, the charitable deduction may be more valuable because you are offsetting income in a year when your tax burden is unusually high. A donor-advised fund allows you to act on the tax opportunity without forcing you to rush all of your charitable decisions at once. That is the first lever. Timing. The second lever is asset selection. This is one of the most powerful reasons a donor-advised fund can be so efficient. A lot of people default to donating cash because it's easy, but from a planning perspective, cash is often not the most efficient asset to give. If you own investments in a taxable brokerage account that have appreciated significantly over time, donating those appreciated shares can be far more tax efficient than selling them first and donating the cash. Why? Because if you sell the investment, you may owe capital gains tax, but if you donate the appreciated investment directly, you may avoid recognizing that capital gain, and you may still receive a charitable deduction based on the fair market value, subject to the applicable rules and limits. This is why in many cases, the better question is not just how much do I want to give? The better question is what is the best asset to give? And for many charitably inclined investors, the answer is not cash. It's often the most appreciated asset in the taxable account. This is especially relevant for people with concentrated stock positions, legacy holdings they have owned for years, or taxable investments with very low cost basis. A donor-advised fund can provide a clean way to move those highly appreciated assets into a charitable structure instead of carrying the tax problem forward. That is the second lever, asset selection. The third lever is bunching. This one's incredibly practical. Many families are charitable every year, but their annual giving is not high enough to consistently create a meaningful tax benefit because they do not itemize every year. So they are generous, but they may not be getting much federal tax value from those gifts. A donor-advised fund can help solve that by allowing the family to bunch several years of intended charitable giving into 1 year. In other words, instead of giving the same amount directly every year, they may choose to make one larger contribution to a donor-advised fund in a single year, potentially itemize that year, and then recommend grants from the DAF over the next several years. That way, the charities can still receive ongoing support, but the household gets to cluster the deduction into one tax year. That can be a very elegant strategy. So those are the three levers: timing, asset selection, and bunching. Now, when do those levers really matter in real life? Usually when someone is already charitably inclined and their financial life has become complex enough that structure matters. This may be someone with an unusually high income year. It may be someone with appreciated stock. It may be a family that gives meaningful every year and wants to be more intentional. It may be someone who wants one place to manage charitable dollars, one place to track grants, and one place to involve children or grandchildren in family giving decisions. It may also be someone who knows they want to give but does not want to make rush decisions during year-end tax season. And that is really what makes a DAF useful. It's not just about tax saving in isolation. It's about tax saving plus better organization plus better decision making. Now, where does it usually not make sense? If your giving is relatively modest and simple, direct giving may be perfectly fine. If you're not itemizing and do not expect bunching to change that, the tax benefit may not be meaningful enough to justify the added structure. If you need the money for your own future spending, a donor-advised fund is the wrong tool because once it goes in, it is committed to charity. And if you are someone who values simplicity above all else and already has a charitable process that works well, forcing a DAF into the picture may not improve anything. That is the real test. A donor-advised fund is not automatically a good idea just because it can be tax efficient on paper. It is a good idea when those tax levers actually apply to your situation and when the added structure improves your giving instead of making it more complicated. Now, let's talk about the part that people often ignore when they first hear about donor-advised funds. They are not free. And this matters because even a strategy with real tax benefits can become less attractive if the costs and friction are too high. In most cases, there are at least two layers of cost. First, there is an administrative fee charged by the sponsoring organization. These range from 0.45% to 0.6%. There is also a minimum fee and account value. Second, there are the investment expenses inside the pools or funds you choose within the donor-advised fund. So if you're using a large national DAF sponsor, you will usually see a platform-style administration fee plus the internal cost of the investment options. And here's why that matters. The smaller the account balance, the more noticeable those costs can feel. If someone is setting aside a relatively modest charitable amount and plans to grant it out fairly quickly, the fees may not be worth the extra layer of administration. In that case, direct giving may be cleaner. On the other hand, if someone is contributing a larger amount, especially appreciated assets, and the charitable dollars may stay invested for a period of time before being granted out, then the structure may be much more justifiable. The other thing to watch is minimums. Some sponsors have low or no minimum contribution requirements. Others may require a much larger initial contribution. Some have small grant minimums. Others set a higher threshold. That may not sound like a big deal, but it can affect how practical the account is for your style of giving. You also want to look at the investment menu. If the charitable dollars are likely to remain in the donor advised fund for a while, then the investment options matter because the long-term charitable impact could be affected by how those funds are invested while they're waiting to be granted. And if you are contributing more complicated assets like private business interest or real estate, the cost and complexity may increase quite a bit. There may be due diligence requirements, outside legal or valuation work, and sponsor-specific restrictions on what they will accept. So when you evaluate a donor-advised fund, do not just ask, what is the tax deduction? Also ask, what are the annual fees, the investment expenses, the account minimums, the grant minimums, the investment options, and the likely time horizon for the money. That is a much better way to think about the decision. Because in fiduciary planning, a strategy is not just good because it has an upside. A strategy is good when the benefit meaningfully exceeds the cost and complexity. Let me finish with a few common mistakes because I think this is where people can get tripped up. Mistake number one is donating cash when appreciated investments would have been a better asset. This is probably the biggest missed opportunity I see conceptually. People hold on to their most appreciated stock and donate cash from the checking account because it feels easy. But if they are already committed to giving, that may be backwards. In many cases, the most tax-efficient gifts is the appreciated investment, not the cash. Mistake number two is assuming every charitable gift creates a meaningful tax benefit. Not necessarily. The deduction only helps if it actually improves your tax picture. If you are not itemizing, or if your deductions are already being handled in a way that limits the incremental value of the gift, the federal tax benefit may be less than you expected. Mistake number three is overfunding the donor advised fund. This is a big one. People get excited about the idea of a deduction and forget that the contribution is irrevocable. Once the money goes in, it is charitable money forever. So before using a DAF, I want to make sure a household's retirement plan, liquidity, emergency reserves, and broader financial security are already in good shape. Charitable planning should be integrated into a healthy financial plan. Mistake number four is ignoring costs. Even if a donor advised fund is the right concept, the wrong sponsor or the wrong account size can make it less attractive. This is why comparing fees, grant minimums, service, and investment choices matter. The larger sponsors may have the highest fees. Mistake number five is making the donor advised fund the strategy. It's not. The strategy is thoughtful charitable planning. The DAF is simply one tool that may support that strategy. So when I think about donor advised funds as a planner, I come back to the same set of questions. Is this person already charitably inclined? Are there meaningful tax levers available here? Does the household have appreciated assets that make gifting more efficient? Would bunching make a difference? Is there enough giving activity for the structure to be worthwhile? Are the fees reasonable relative to the likely benefit? And most importantly, does using a DAF improve the client's overall plan or just make it look more sophisticated? That's the standard. So let's bring this all together. A donor-advised fund can be a very effective tool for tax-efficient charitable giving, but only when it fits the right situation. First, a DAF can create efficiency through three main tax levers: timing, asset selection, and bunching. Second, it often makes the most sense for charitably inclined families with unusually high income years, appreciated investments, or a desire for more structure around giving. Third, it can help separate the tax decision from the charitable grant decision, which gives you more flexibility and often a more thoughtful process. Fourth, it's not free, so fees, minimums, investment choices, and complexity all matter. And fifth, it's not always the right answer. Sometimes direct giving is simpler, cleaner, and more appropriate. A donor-advised fund is not automatically smart because it's available. It is smart when it matches your values, your tax situation, your investment portfolio, and your broader financial plan. And that is why planning matters, because the best charitable strategy is not the one that sounds the most advanced. It is the one that helps you give intentionally, reduce unnecessary taxes where appropriate, stay organized, and still protect your own long-term financial freedom. Thanks for joining me today. If you would like to learn more about how F5 Financial Planning helps our clients achieve financial freedom for personal significance, please visit our website at www.f5fp.com.